through attorney review, through the initial review, through home inspection, your loan's in process. Now what? So let's pause here for a second and let's go through who's in your life right now as a buyer, and let's figure out who we're going to pay and how they're going to get paid, right? So first of all, you've got your real estate agent. You have your attorney. In Illinois, we have attorneys. Not every state has an attorney. In Illinois, we do. In the Chicago market, we do. Do you pay your attorney? Yes, you do. You have the lender. Are you going to pay the lender up front? No, you're not. An appraisal is basically anywhere between a 20 to 50 page report on the value of your home in that moment at that time. What does it mean to you? Well, it establishes whether or not the purchase price of your home was largely correct. The impact of an appraisal can be very, very significant. You always pay usually anywhere between $350 to $500 typically for a really garden variety property. If it's a bigger property, more expensive property, you may pay as much as $800 for an appraisal. If it's at the purchase price, you'll never hear about it. If it's above the purchase price, your lender will probably reach out to you and say, hey, good news, you have more ownership in your home. You bought it here, it appraised for here, so this extra amount of ownership is yours. Congratulations. And that's a happy day. If the appraisal comes in below where you bought the price, or if the appraisal comes in below where you thought the appraised value was on a refinance, you may have an issue that needs to get cleared up. If you're buying a home, it needs to be brought up with your real estate representative, as well as the listing agent, the person that's listed the home, and said, hey, we've got a gap. Can we negotiate out this gap? Because we bought this home, we agreed it was worth here, but the appraiser said it's here. You do have avenues to fight an appraisal if you feel like the appraisal was poorly done, if you feel like they made a mistake. Be prepared for pushback. You know, when an appraiser files a report that is lower on a purchase price, let's say, they know that they're going to have an impact on a transaction. They know that they're going to have to defend their work. So be prepared for that person to also defend what value they came up with and what comparables that they used. What are their comparable properties on closed sales that they used to come up with that value. And then the home insurance, of course, you got homeowners insurance. So either before the transaction has closed, so during the process, or at the closing table, you're gonna buy a homeowners insurance policy for the property. For a single family, it's just you, okay? So your insurance is gonna cover that particular property and no other property, it's just you. That's different than a condo. A condo, the insurance is going to be covered that you're going to buy is usually going to be a walls in policy, meaning everything inside, and then the condos association is usually going to have its own master policy. It's what it's called, master policy, that covers everything external to the property. We're going to go from where we are at the end of the attorney review period, and now what you're going to be doing as a buyer to make sure that your loan closes on time. loan itself is now in focus. Well, there's four main areas, there's four main quadrants that represent different people in the life of the loan process, okay? The first part is the upfront process, which is the loan officer. A good loan officer is going to ultimately ask you for upfront income documentation. He or she is going to do a very thorough interview. It's going to hopefully feel like a conversation, not an interrogation, but they're going to ask questions. They're going to ask questions about your life, who's going to be on the loan, how many kids you have. They're going to be asking some legitimate questions about how you make your living, and they're trying to figure out two things: your willingness to repay and then your ability to repay. The loan officer is not ultimately responsible for the approval of the loan. That does not come until later. After the attorney review and after the loan has been fully submitted, meaning most or all of the documents up front have been taken up, it goes to quadrant 2, which is the processor. Okay, and the processor is a loan document specialist. Their jobs is entirely to deal with the documentation. Now, a good loan officer is going to get, all of or most of what they need on the income side up front. And then when it goes to processing, the idea is the processor takes what you've already gotten, you send it to the processor, and then the processor takes a look at the file. If they can, if you missed anything, they'll ask you, the buyer, for anything that the loan officer may have missed and that they know they're going to need. After the processor thinks that they've got everything that they need to submit to underwriting, they submit to the underwriter, which is quadrant number 3. The underwriter is a person who is going to look at you on paper. It's not likely that you'll ever speak to an underwriter. But the underwriter is basically, if you can picture somebody cracking their neck and putting in their earplugs or putting in their earbuds to listen to some sort of soothing music, Enya, Sade, I don't know what you listen to. But they're gonna look at you on paper as a buyer, and they're gonna say, okay, well, tell me about this Mr. or Mrs. Buyer, and what do they look like on paper? And they're going to look at all of the documents that have been submitted. They're going to look at what you're attempting to buy. They're going to look at how much you want to borrow as a percentage of that. And they're going to look at all of the things that we talked about early on: credit, assets, debt, and income. And they're going to take that approach and look at every single thing. And at the end of it, they're going to take their earbuds out. It can be, a 2-day process. It can be a 1-week process. It can be a 6-hour process. It can be depending on the complexity of you, the buyer, and their workflow, because during peak seasons, they have more files to underwrite, so they might not get to your file immediately. And they're going to say one of a couple things. One option is the best option, which is, yes, we've issued conditional approval. Or another option would be, okay, I'm not saying no, but I need to know more about this, or I need to know more about this, or I see that this happened in the credit report, but I need to know more about it. I need to have a little bit more information to feel comfortable that that is no longer an issue. So that's a maybe. And option 3 is, I don't think this is a good loan to do. And in that case, the no basically will go to an escalation team. In most lending situations, one person isn't beholden to whether or not a file gets denied. You as a buyer have the right to have that double checked during the process, and usually if somebody has denied it, somebody else will take a look at the file independent of the first person to confirm that the denial is for the right reasons. If there's anything that can be done to restructure something that is denying the ability to approve the loan, they'll bring that to you. But that is the underwriting process in a nutshell. We've gone through 3 quadrants. We've gone through the loan officer is quadrant 1, and we've gone to the processor, quadrant 2, and we've gone to the underwriter, quadrant 3, and then quadrant 4 is the closing department. Responsible for hitting the send button on the money. That's the simple way to do it. So in the next video, we'll talk about what it means and what your role is going to be in this whole process and when you pick up with your actions again.